everybody. Great to have you here with us. I'm your host, Caitlin Cormier. It's no secret that early retirement is a dream for many Canadians, and investing can be an important part of helping to make that dream a reality. One of the conventional strategies is to build up a portfolio over many years and then gradually sell those investments to fund one's retirement. The thing is, that approach didn't appeal to Adrian and Erica. Instead, they pursued an income focused strategy that you could say is a little outside the box. That strategy, along with some savvy financial decisions, helped the pair reach their financial independence before their 40th birthdays. Adrian and Erica share their investing journey on their YouTube channel called Passive Income Investing, and today they're going to break down their investing strategy for us. Welcome, Adrian and Erica. It's great to chat with you.
Nice to be here.
Thanks for having us.
Congratulations on reaching financial independence before your 40s. That is amazing. And the recent move to Panama. Okay, so tell me, what was it about Panama that you loved so much to move there permanently?
Well, permanently is a very long time, I would say, for definitely for the next little while. But probably my favorite reason is the year-round weather. It really makes it easy to have an active, healthy lifestyle outdoors. Panama is a really nice, beautiful country. I mean, it's got the largest biodiversity, like I think in North America, Central America. So if you take an organized hike, you can actually see sloths and monkeys and all sorts of bird species. And just sitting on the balcony here, we get to see like pelicans and beautiful, beautiful things that I've never seen before, right? So the people are very inviting, welcoming, and there's a general respectful, ambiance here. Nobody really wonders why you're living here. It's part of the Panama culture now.
Yeah, I wouldn't say, we just packed up and went
Right.
to Panama, right? We did spend a whole winter here first to see how we liked it, and we did fall in love with it. So that's when we took the steps to, we're not going to just move anywhere, right? So we definitely wanted to test it, and testing it during the winter, we were very happy.
And Adrian, as we go along, I'm sure our audience will get to know that you don't make the decisions very lightly, that you do lots of research and have a lot of reasoning behind those decisions. And also, I'm sold. So if you have an extra room, just let me know and I will be there.
We have 2 extra bedrooms.
Perfect. Sounds great. Okay, so you're there. You're in this lovely, wonderful place that you've picked out. That sounds absolutely fantastic. So what is next for you?
We plan to evolve the channel and really make a space, on the internet for folks like us and who are thinking about maybe doing the same thing. And we just want to have some sort of grow our community to share what we're doing and hopefully, help other people on their way.
Yeah, exactly. I mean, people associate fire sometimes, that retirement word, negatively, that you're just going to sit on the couch and do nothing. But we're actually more busy now than we've
Yeah.
ever been. But it's a good and happy busy because we actually get to do whatever we want, whenever we want on our timetable. And we're actually helping people every day, which is the best part. So we're not out there to try to convince people that our investing strategy is the best. I'm just showing people, we're showing people what we do, and hopefully there's lessons learned.
So you both invest in funds that pay dividends as part of your strategy, as we'll hear more about. So before we get into our conversation, I just want to kick things off with a quick trivia question for our audience. So dividend paying stocks are a key component of the S&P TSX Composite Index. What percentage of the index's average annual total return did dividend payments contribute between 1986 and 2016? So stay tuned. We will reveal the answer at the end of our presentation today. Okay, it's not every day that someone can quit their job as early in life as you both did. So take us through your financial journey and some of the key investing decisions you made along the way that helped you get there.
We actually didn't start with income oriented investing. I was just investing for fun at the beginning. We actually focused a lot of our, or most of our, disposable income on paying off our mortgage first. So that's a key component for us, for our journeys, is obviously, to reach financial independence, you got to get rid of your debts, right? So for us, we paid our 20-year mortgage in 7 years. And it's really only then where we realize, wow, we're going to have a lot more disposable income once that mortgage is paid, because we were paying an accelerated mortgage. So it was a really big chunk. So once that chunk of money becomes available, we have to figure out what we do with it. And that's when I really started doing a deep dive in dividend stocks and dividend investing, income oriented investing. And it was a natural and slow progression to the style of investing or the type of investing that I do today. I started like everyone else starts, trying to pick stocks and trying to see what the flavor of the day is or the flavor of the month. But eventually I kind of passed that and really started focusing on, okay, what's best for us. And the answer was basically what we do now, the income oriented style of investing.
So, as far as your timing with all of this, you reached financial independence just before the pandemic, which certainly rocked the financial markets and the global economy, among other things. What gave you the courage to stick with your investing strategy through all of that uncertainty?
Yeah, it's kind of a joke. So we actually always have the worst timing. So this was a good lesson. And, this is what actually gave us the courage right away to stick with it because, we sold our condo, decided to sell our condo at the end of 2019. And the day after I got the whole proceeds of that, I invested it literally in 1 hour. I invested like over $400,000 in 1 hour. It was pretty fun doing it, a lot of adrenaline. But then, as you know, 3 months later is when the COVID-19 stock market crash occurred. I look at it as a blessing because right away I got to see how this strategy really pans out during the market bad times. The overarching principle is really a buy and hold principle where you're not trying to figure out when to sell your stuff, when to beat the market. We're in the market long term. I sometimes say forever term, not instead of long term, and just collect the income
Yeah.
as we go. Opposed to, for example, traders or speculators that have to consistently get in and out. So this is really long-term investing. It's very conservative investing. It's not trading and speculating. That stuff is pretty nuts even for me.
I remember, our portfolio value did go down like 30%, and we were talking about it because we were like, just our luck, right? And what really, gave us comfort is knowing that the fundamental investments are blue chip companies. So it's just a matter of really like keeping your discipline, remaining focused on your goal, which is to consistently invest every month to build up that portfolio. Because as you do that, you're building up your portfolio value as well as the monthly income coming in. So
I find it interesting that you broke with conventional wisdom, which typically sees investors focused on capital appreciation in their earlier years and then shift to income investing in their later years. What gave you the confidence that a high yield income strategy was the right approach for you in your 30s?
We tested it first, and once we got to $1,000 a month of dividend income or passive income, I should say, that really gave us the courage. And you also have to think about your goal. So investing is not black and white. A lot of people, seem to ask, what's the best investing style? What's the best ETF out there? I hate when people ask those questions. I get those all the time. You should be asking, what's the best for you? What's your goal? What's your objective? What do you want to do in life? So for us, financial independence was the number one goal. We basically did not want to rely on jobs, 9 to 5 jobs. I'm not saying we hated our jobs, but we definitely could make do without. That's for sure. So it's really about the freedom of always being okay, having that security, just like a job has. So essentially, it's replacing your paycheck.
mhm.
And the income oriented style, where you're really squeezing out as much income as you can right away, it jived with our objectives and our lifestyle needs, which was to hit that financial independence as soon as possible.
Being able to put a lump sum in a portfolio that generates income, it really gives you a psychological kind of calm mindset, knowing that this income will be paying your bills on a monthly basis, no matter what's going on the market. A great advantage of the income strategy is actually, you have to think of the monthly income for what it is, which is realized gains. And so instead of waiting for the growth, you get your gains every month and you could decide what to do. You have more flexibility, you have more options, and more control of your finances and your investments.
Okay. It's all so I find it so interesting. And for those in our audience who want to hear a little bit more about another journey for early retirement, albeit with a very different investing strategy, check out our webinar How I Reached Financial Independence While Raising a Family with our guest speaker Courtney Chase. Okay, I want to pick up on something that you've said that you don't care about asset prices. So why is that? So after all, total return is also something that many investors care about.
Yeah, yeah. So yeah, I say it all the time. I don't care about stock prices. I don't care about asset prices. Well, that obviously is a little exaggeration, but it kind of is true, and that's simply because of the strategy. It's a buy and hold strategy where you're making your money, you're realizing your gains every single month without selling anything. So if your portfolio, or like you said, the asset prices, those change every day with the stock market, right? They could go up, they could go down, they could stay flat. But if you're just living off the income and you're making most of your returns with the income, not by buying low, selling high, do you really care what the day to day, week to week, month to month, even year to year price of the assets are? Not really. Whereas a growth investor, that's pretty much all that matters, because they typically have very, very low yields or dividend yields, if at all. So the bulk of your returns are really coming from the capital appreciation.
Okay, yeah, very good. And so the idea is, I guess, that your portfolio, even if it's down in value, you're hoping the quality of dividend is going to continue, that it's the company that's going to continue to pay throughout that type of market. So that's why you're not as concerned. Well, you don't care about share price. It's more just that you care more about the dividend being consistent. Okay, very good. Okay, so let's get into the investing strategy. Let's break it down. Can you share a snapshot of the types of high yield income funds you hold and the share of your portfolio that they each make up?
First thing I will say is the fundamental, or the basis, is always, like I mentioned before. I'll keep mentioning because it's very important. Are blue chip stocks. So no matter that, that's always the base or the foundation. So is it exclusively blue chip stocks? No, but I would say maybe 95%, something like that. So that's number one. Number two is the bread and butter of the income enhancing strategy. Yes, there's dividends. That's one component. But the second component is covered calls. So most of everything we have, there's covered calls on it. So if there's dividends and covered calls, your yield is going to be up. On top of that, there is also some leverage. So this is not leverage or margin that we're taking ourselves. We're investing in funds that use margin or leverage. So it's very modest. And another advantage is it's managed by the fund manager. They get much lower interest rates than we can. So that's basically it. So it's really dividends, covered calls, and leverage, though, that make up really the income enhancing strategy, on top of a good diversified portfolio of blue chip stocks. So there's many covered call fund type of funds out there. There's just the regular I call them vanilla covered call ETFs, where they're not leveraged. They're just a portfolio of stocks. So you get the dividends and the covered calls. Then there's some funds or ETFs that hold multiple covered call ETFs to get that diversification. So, for example, you might have one that focuses on utilities, one that focuses on the Canadian six banks, healthcare, technology. So you're getting diversification all in one fund, which is absolutely incredible. Think of it kind of like an index fund, right? And on top of the whole fund, or on the whole, they add 25% leverage on it. So it's a very modest amount of leverage. But all these factors together, you could easily hit your 9, 10, 11 or more percent yield.
What we do is very conservative. If you look at the fact sheets of all these covered call ETFs, they're
Yeah.
labeled as defensive because you're, regardless of what is going on with the market, your volatility on the income you receive every month is not affected because of these enhancing strategies, which just uses options in order to achieve that. So once you break it down and understand how you're getting the income, you realize that these are strategies that are going on all the time. People they activate option strategies on their own accounts so they could try to do it, but we just we pay the little management fee, we let them do it, and we get the results every month with the income. So another psychological advantage there.
I wouldn't want to do right covered calls or options on my own.
Right.
It seems very tedious and complicated. I'll be completely honest. Do I know exactly the mechanics of how options work? No, I don't even have options trading enabled on the account, on our broker account. But these ETFs are professionally managed by professionals that are writing covered calls for over 10 years, right? So, but of course, the management fees are going to be a little bit higher than a passive index ETF.
Right.
That's completely normal because
It's actively
it's
managed.
more actively managed. They got to go in and write the calls every month. But we're not talking about 2% like mutual funds. We're talking about typically less than 1%
Yeah.
all the time. So for us, it's worth it to be completely passive. We're very comfortable. We also have some split share funds, so sector diversified split share funds, and even some financial split share funds. So these are would be just financial stocks. So those are leveraged as well. We also have real estate. So just because I we sold our condo and we rent a condo in Panama doesn't mean we don't like investing in real estate. We actually really like real estate. So a goal of ours is always to have about 10% in real estate.
Okay, very good, very good. I really appreciate you giving us kind of a look behind the curtain at the process behind building your portfolio. Now, there are several different types of income funds that you use as part of your strategy, and we don't have time to cover them all, unfortunately. That said, I wanted to spend some time to hear a little bit more about those covered call ETFs that you talk so much about,
Sure.
like that really key piece to your strategy. So, can you explain what a covered call is and how covered call ETFs work?
In the options world, there's basically two types of options. There's a call option and there's a put option. So the call option is a buy option. It's an option to buy a stock. So a covered call ETF or someone selling, because you could do it yourself. If you're selling call options, you're basically selling a contract or an options contract to another investor to buy the shares off of you at a specified price, which is called a strike price. So I'll just give a brief example. So let's say TD stock price is $100. So you could sell a call option to another buyer at $105. So let's say that expired, the contract is 30 days. So right now TD is $100. You sell the option for $105. That means that within 30 days, if TD stock price goes above anything above 105, you basically have to sell your TD shares to that other investor for 105. So if it goes to 106, 107, 108, you're obliged to sell them at 105. So you're giving up the gain between 105 and 106, 105 and 110, whatever it is. So that's a call option. Now, because you're selling that option, you're making a little premium off of that. So that option, let's say you make $3, a $3 premium, because let's say you sell one share, right? So if at the end of 30 days, TD stock hits 105 on the nose or less, 104, 103, go under $100, it doesn't matter. That contract expires worthless. So we get to keep our TD shares because we only get called away or have to exercise it if it's above 105. So we get to keep our TD shares, but we also made a little $3 profit because that's the premium. So that's the mechanics of what a call option is. And the reason they call it a covered call is because we already own TD stock. So in case the stock goes to 106, we already own the TD stock to sell to the buyer of the call option. So that's pretty much how a covered call option works. So that's why they typically cover call strategies underperform during a strong bull market because there's more of a chance that TD stock's going to go to above 105. But if the market's not doing that well, it's staying flat like it kind of is now. There's a very low chance that the call is going to be exercised. So this is why covered call strategies tend to do really well during the flat and bad times, basically. So that's a general premise behind it. So it's a little income booster. It's an income enhancer on great stocks that you're happy to own for the long term. So you're getting an enhanced yield and you're getting a little bit more defense, a little bit more consistency because your returns are more consistent. That income is fairly consistent.
Yeah. To add to that example, a typical covered call ETF, for example, that holds blue chip dividend stocks. So that yield is the covered call ETF yield will be higher because it has two sources of income. First, the dividend stocks in the underlying ETF that provide the dividend, and second is the call option. So it's important to understand that the call options are not done on the full ETF, meaning
True.
that it won't be 100% of your shares that will be put on this options market, right? So each fund manager has their system, could be 50%, could be 33% of the ETF. So you will capture that part where it sells the option and you'll get the premium, but also you will capture a growth because you're not doing the covered call on the entire ETF. There are funds that do it on the entire thing, so it's important to know, to know this while before you invest in it, how much percentage of the actual ETF are they doing the covered calls on. So the higher the percentage is, the less likely it will go up during a bull market because likely they'll be exercised.
Would you consider the call option assignment a risk as well, like the potential for those call options to be assigned within the covered call ETF?
Well, that's the thing. It depends how aggressive, and we don't really talk about it too much. We talked about portfolio coverage, but there's all the second factor of the cover call strategy is the moneyness of the option. So the example I gave, where TD stock is 100, we're selling at 105.
Right.
That's a more conservative option because it's out of the money. So even if the stock goes to 106, 107, you participate in a bit of upside. But if you're selling always at the money, call option. So if TD stock's 100, you sell the option at 100, there's a much bigger chance it'll be exercised or your stock will be called away, but the premium is much bigger.
Okay. Lots to consider, lots to think about. So, why do you like covered called ETFs over more traditional high yield dividends funds, for example, to help support your financial independence?
Well, I would say yield is the most important factor. For example, if you invest in a passive index, Canadian index like the TSX Composite Index or the TSX 60, you'll get maybe 3%. Last I checked, 3%, maybe a little bit higher than that of yield. Or if you just go with a just dividend stocks in Canada, for example, maybe you'll hit 4%. So that's still really, it's not bad, but it's not enough to live on unless you have
Yeah.
3 4 million dollars, and we don't have that kind of money. So this is a different way to do it where you don't need as much money, because if you're making 8 9 or like our portfolio right now is making a little over 10% yield, all of a sudden you need a lot less money to make your enough money to pay your expenses, whether it's 4,000 a month or 5,000 a month. So yield is the biggest consideration.
Just a quick note for our audience, if you'd like to learn more about covered call ETFs, check out our webinar, How to Generate Passive Options Income on a Budget, in the Learning Center. So, in looking at the different income funds that you invest in, what are some of the factors that you look for to help you decide whether it might be right for your portfolio?
Yeah, so this is where the analysis comes in. I actually go on the sites, read the fact sheets, the boring stuff. I kind of like it. So we discussed a bit of these points earlier. Number one is always stock quality. So before you look at the yield, how they make the yield, who the investment manager is, what are the actual stocks inside the portfolio? Because covered call ETF is nothing abstract. You're still investing in a portfolio of stocks. So you got to look at what those stocks are. Second factor is diversification. So of course you have some funds that are already diversified. Some funds are more sector specific, like financials and or real estate, and that's okay. But as a whole you're diversified, it's good. So those are two key factors. After that, I look at the income, obviously. So yield is a big factor. How much yield am I getting? How long has the provider or the ETF manager provided these dividends? Have the dividends ever been reduced or cut in the past? Right? What is their covered call strategy? Do they have other products? And how are they performing? So these are all factors that I look at. Of course, total return is a factor. But I wouldn't say, unlike most investing strategies, it's the most important factor. It is an important factor, but it's really about replacing your paycheck. So it's really about the consistency of the income. So how consistent are these distributions? So these are all the factors I look at when trying to decide, which ones to put in my portfolio, which ones to remove. So those are the basic factors. So many of the same ones as a regular investor.
So the strategy works really well for both of you, but it is not necessarily for everyone. So what would you say are some of the downsides to consider with that income focused strategy approach?
Yeah, so I talked about it just before. The only real big downside is you're probably going to get less total return over time. So anything that uses covered calls, it does really, really well, or it tends to outperform or do better than something else similar without the covered calls during a flat market, during a down market, because those options are not going to be exercised. There's very low chance. But over time, you're probably looking at less total return. So I'm much more popular than with the retirees and the older crowd than the younger crowd, because typically people who are about to retire or retirees really want income above all else. But if you're younger and you're going to spend 20, 30, 40 years in the market, probably, we can't say for sure, but history has shown us that probably you're better off with, growth style of investment, or even dividend investments without the covered calls.
Yeah.
Okay, thank you for sharing your perspective on income investing, Adrian and Erica. You've certainly given us a lot to consider for those interested in income investing strategies. Speaking of which, I want to take a moment to show our audience how they can use the screeners tool within WebBroker to find high yield income funds. So let's dive in. All right, now that we're in WebBroker, we're going to click on research, and under tools, we're going to click on screeners. We're going to choose ETF screeners, and we're going to try and screen specifically for those covered call ETFs. We have some featured screens, some saved screens for this profile, but we're going to go right to custom screen. And the first criteria we're going to look at in order to kind of filter down these ETFs and really find those covered call ETFs is we're going to click on distribution yield. So this is going to tell us how much distribution is happening with these particular ETFs, and we're looking for the highest distribution. I am going to uninclude mutual funds in this screen result. I believe we only have those ETF cover call options, so let's go that way. And then we're also going to click distribution frequency because we still have 766 matches available. So what I'm going to do is I'm just going to add and say that we'd like monthly distributions, and I'm also going to choose just Canadian funds to get us a lower number there. So our total number of matches now is 210. That seems a little bit more reasonable. I'm going to click to view matches. Here I have my results. There's a ton of information I can go through to decide which different funds I might want to take a closer look at. But what I'm going to do today is I'm going to scroll down and focus on looking at those cover call ETFs. So here I see the distribution yield, the monthly distribution frequency, and the country. And I want to choose up to 5 different funds to compare. So I'm just going to choose a couple here. Just bear with me for one moment, and we'll hop right into the comparison tool and see what we can see. Okay, I have 5 different funds. I'm going to click compare, and it's going to take me over to this fund comparison screen. So all 5 different ETFs that we've chosen are across the top. As we scroll down, there's a lot of different information we can see about each fund. So first we have the summary, so it's telling us what the focus of the fund is. We've got Morningstar rating for those that are available. The MER is listed, distribution yield. I can click on profile and see how long the ETF has been around for, the portfolio turnover, how long the manager has been there. I can view ratings information again for those that it's available for. I can see both annualized returns as well as calendar returns for these ETFs. I can see different risk measures over different periods of time. I can also see holding allocation, so what different asset classes are within this particular fund, or geographic region, if I'd like to see where they're based, what different countries they're based in. It just sort of gives you an idea of all the different information you can find through the ETF screener to be able to really narrow down which different ETF might be right for you. Okay, hopefully that demo helps our viewers get started with their research into income funds. Now, we're going to have to wrap up our conversation here, but before we do, let's reveal the answer to the trivia question. As a refresher, the question was, dividend-paying stocks are a key component of the S&P TSX Composite Index. What percentage of the index's average annual total return did dividend payments contribute between 1986 and 2016? The answer is Dividend payments represented roughly a third of the average annual total return of the S&P TSX Composite Index between 1986 and 2016, according to data compiled by Morningstar. Returns including reinvested dividends were also significantly higher than returns excluding them. Does that sound about right to you guys?
Yeah.
Yeah, I'm actually surprised. I thought it would be more, but
Yeah.
I knew it would be a big chunk
Yeah.
for sure. Yeah.
Yeah. It is amazing, that power of reinvesting, that snowball effect, eh? Thanks again so much for taking the time to speak with us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center. See you all next time.